But as I speak here, gold is down almost $400. We're at 4,100. Am I concerned? No, because I've been through this before. Back in '08, that's what happened. I was sitting there and I couldn't believe it. Gold should have been going up. But I think a lot of people are talking now about a liquidity crisis, and that could be so. And gold, of course, is the most liquid form of money. It has been for thousands of years.
Once it breaks out, it has a parabolic move, but then it wants to come back in and tag that same level, kind of revisit the scene of the crime. Then it can start its next move to the upside. And that's kind of what I'm expecting here. We had the bigger breakout. So 3,500 is that level where, again, at that point, I would say, okay, for me, there's a very low risk of getting into gold at this price. I think it actually starts to grind back to the all-time highs. And I think that we're still on pace for $10,000 gold. It just may be a couple years away.
Gold rebounded from earlier losses on Tuesday, but stayed firmly in bear market territory as a stronger US dollar and elevated Treasury yields continue to dull the yellow metal's allure. Some analysts noted the sell-off was a natural correction after an extended rally fueled by geopolitical uncertainty and structural demand. Gold rose over 64% last year. Veteran technical trader and market strategist MarioInnecco and Gareth Soloway give insights on commodities, stocks, and precious metals. In this video, MarioInnecco notes that the recent drop in gold and silver mirrors past crises like 2008, where prices initially fell before surging higher. He stresses that such declines often occur during liquidity squeezes, when investors sell even strong assets to raise cash. Recent news supports this view, as gold and silver have experienced sharp sell-offs followed by quick rebounds, largely driven by shifting interest rate expectations and liquidity pressures rather than a breakdown in fundamentals. For example, both metals dropped significantly in March. Silver fell over 10% at one point, yet analysts noted that investors were rotating into cash and higher-yield assets amid rising rates and a stronger dollar. At the same time, prices rebounded shortly after, with gold climbing and silver gaining as market conditions stabilized and inflation fears eased. From a technical perspective, ongoing inflation, monetary intervention, and potential yield curve control will continue to erode confidence in fiat currencies. He emphasizes that central banks and governments may try to stabilize markets, and believes holding physical metals remains essential as global tensions and financial instability could escalate further. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from MarioInnecco and Gareth Soloway's recent interview.
I've said many times to you, you need to hold on to your gold and silver for dear life. And I think right now what we're experiencing is similar. The event is totally different to what happened in '08, but it's very similar to that event when gold dropped from like 1,000 in March to like 680 in September, and it dropped to 680 when Lehman was collapsing, right? It made no sense. And I remember that really well. Let's have a look here. So it was in a testimony in Congress in 1999 that Alan Greenspan made that comment. He was serving as the chairman of the Federal Reserve, right? And that's what he said. In extremis, gold is the only form of payment. And I've done a little more. He said, during wars, fiat money is not accepted. And unfortunately, I think this war is going to get a lot worse. And what we're experiencing, though, in gold and silver and in treasuries and in stocks, even though stocks are holding on relatively well, I'm sure there's a lot of intervention as well. I'm sure U.S. Secretary of the Treasury Bessent is very busy with his publicly funded hedge fund, the Exchange Stabilization Fund. doing all he can to keep the dollar and treasuries from collapsing. And I think part of it is hammering the price of futures, of gold and silver. I don't see people getting rid of their gold just when the world is getting so chaotic. Maybe a few people at the fringes in the Middle East need to sell their gold, but I don't even think the Middle Eastern countries that have been buying a lot of gold and silver are going to be the last thing they sell. Some people think they are selling it. No, I think what they're going to be selling are treasuries. And yeah, and as I've said, hold on to your gold and silver for dear life. This is exactly the wrong time to get rid of it. If anything, I'm going to be trying to buy more physical gold. Well, I'm not going to be trying. I will be in the next couple of weeks. I'm waiting for the beginning of the tax year to free up some funds, right? To try to make sure I don't pay more tax than I have to, unfortunately. So, yeah, it's interesting because Alan Greenspan, he turned 100 years old on March 6th. So he's been around a long time. And the essay he wrote, Gold and Economic Freedom, I've talked about it here on this channel quite a few times. Maybe not recently, but I'm going to put a link to it below in the description. And it's a great essay. It explains what gold is, how statists hate gold and the gold standard because it disciplines them. It makes a welfare state very difficult to run. And he believed in all that. And how do I know that? Well, because when I met Ron Paul at the Mises Institute in 2002, he told me the story about Alan Greenspan when he was testifying, because Ron Paul was in the committee, banking committee, and he used to question Greenspan. Ron Paul brought the Golden Economic Freedom essay to him for him to autograph, to sign. And he asked Greenspan, do you still believe in everything you wrote? And he said, I do. He said, the only problem is that the general public, and this is all about politics, they always want the freebies. They always want inflation. And yes, talking about inflation, I think it's going to continue. I've seen that President Trump is ordered Fannie and Freddie to do more quantitative easing or even yield curve control. How are they going to do that? Well, they're going to just create $200 billion out of thin air and start buying mortgage-backed securities to bring down mortgage yields. Yes, I'm not making this up, but as I speak here, gold is down almost $400. We're at $4,100. Am I concerned? No, because I've been through this before. Back in 2008, gold should have been going up. But I think a lot of people are talking now about a liquidity crisis, and that could be so. And gold, of course, is the most liquid form of money. It has been for thousands of years, and silver as well. And that's why probably they're coming down. So silver's trading at 61. The Dow is only down 300 points, but I suspect it's going to be down a lot more. S&P is down 58, and the Nasdaq is 100, only down 1%. We're seeing the dollar strengthen, but not much really. The dollar index still trading out around 100, and as I've said many times, the dollar index was at 100 back in 1973 when it was created. Gold was at 85, and here we are 53 years later, and the dollar index is at 100, has gone nowhere, and gold is at 4,000. So that's how I would look at it. I think, if anything, this is how they're confiscating and scaring you away, trying to scare you away from your gold and silver, trying to stop you from also getting some gold and silver to protect yourself. I'm thinking the worst. I think we could see this crisis evolve into a major, major war. I mean, World War III. We'll have to see what develops, how this week evolves.
During the interview, Gareth Soloway emphasizes that gold's recent behavior suggests it is temporarily acting more like a risk asset rather than a traditional safe haven. He explains that this shift is due to speculative investors entering the market for quick gains, and as those weak hands begin to exit, prices could continue to decline toward the $3,500 level before a stronger long-term uptrend resumes. He predicts that in the near term, gold may see a short-lived bounce, but the overall structure still points to another leg lower unless key resistance levels are broken. Regarding silver, he mentions that it is more volatile and currently more oversold. However, silver has potential downfall toward the $50. Despite this short-term bearish outlook, Soloway emphasizes that both gold and silver remain strongly bullish over the long run, with the potential for gold to eventually move toward $10,000 once the market fully resets and stabilizes. Let's jump into the interview.
And I would say this is that in general, oil is going to come in. And then I also think gold, like you're saying, is still going to head down to that 3,500 level. And one of the concerns I've had for gold, and this is one of the bearish case scenarios, is that gold has been reacting like a risk asset. And so, for instance, this morning when oil was up before the Trump tweet about talks with Iran, we saw gold selling off. And when the markets rallied back, that's when gold snapped back. And what that tells me as a technician of the charts and a psychological indicator for investors is that they are using it as a risk asset, which means it has to flush down lower until you get those hands out, the weak hands as we call them in the trading world. Once the weak hands are out, it can resume its safe haven asset status and then move up. So I would say overall is that ultimately it's not going to matter, but I do think if markets rally here in the near term, then gold does catch a little bit of a bid. And if we take a look at my chart here, we can see that we have the chart at 44 to 4,300. And as of now, we've regained that zone. And so what I would say this is it gives it a near-term bounce bias on gold. So I would expect gold to trade back to, let's say, potentially 46 to 4,700. Ultimately, I'm watching this 44 to 4,300, a daily close below that. That's where you start to get your next leg lower to potentially 3,500. And again, just to show the chart here, you can see how this level was the support zone, and that initially was tagged when we had the initial drop from 5,600. We then bounced. This created what we call in the industry a bear flag formation, an inside bar move, which then rolled over, and it's struggling right here to hold that 4,300, 4,400. So in the near term, I'm actually flipping to slightly bullish, looking for a bounce, but then ultimately I would expect another leg lower, finally washing out the weak hands that bought this on the kind of the risk on trade, the easy money trade, and that's where we'll get that final one, and that's where I'll be buying physical metal. So I'll trade, listen, I'm a swing trader, so I buy and sell in here for these bounce plays, but the physical metal I don't trade, I hold on to that. That's where I buy around 3,500. What I do is I go back to the charts and I say, okay, well, at 3,900 here, we're going to have some support. You can see this pivot going back to October, late October of 2025. But ultimately, the big level, look at how price behaved going back to April of 2025, then again in May, then it hit it again in June and July, and finally broke out of that base plate right in September. And so what charts tend to do, when you have a line here of resistance and price keeps hammering on the underbelly, once it breaks out, it has a parabolic move, but then it wants to come back in and tag that same level, kind of revisit the scene of the crime. Then it can start its next move to the upside. And that's kind of what I'm expecting here. We had the bigger breakout. So 3,500 is that level where, again, at that point, I would say, okay, for me, there's a very low risk of getting into gold at this price. I think it actually starts to grind back to the all-time highs. And I think that we're still on pace for $10,000 gold. It just may be a couple years away. I'm in the camp that silver is just more oversold, and I also think silver is a slightly higher risk-on asset than gold. And again, gold historically has not been risk-on versus silver has been, right? When the economy's good and demand for silver is out there and climbing, it tends to perform better than gold. And so I think today's is that bounce back in the stock market here. You're seeing it rebound. It's still a concern though, because we have this low zone here around 70 to 71, and we're still holding below that level. And again, we closed below on Friday. We saw the big flush today getting close to $60 an ounce. And it is bouncing, and I still think there could be a sustainable short-term bounce, but I would still be in the camp that silver is going lower, and I still have a low-end target here of $50 to $54, which I've maintained, by the way, since we saw this initial flush. And even when we were back to the 90s, this chart is, again, a great example. If we look at the structure here, this kind of pattern formation is all consolidation. A bear flag is what we call it in the business. And again, you can see that right here leading to this rollover. And it's just, again, just so everyone understands, is when you're looking at a chart, patterns repeat because human nature and psychology doesn't change. And so bear flags tend to tell you that there's a high probability of that next leg down. And that's what we're seeing here on silver. Right now, the chart is kind of teetering on the edge of a cliff right here, this 70 to 71 level. You need to see price get back in here. If it gets it back in here, we could make a move back up to about 91 to 93. That's the high of the last bounce here and also the initial bounce right in here. And so if the price could get above 93 and really break, then you're all of a sudden back in the bull momentum and you could head back to 120. But again, anything in between 70 to 71 and 93 to 91 remains bearish consolidation and eventually leads lower. It's just a matter of time. And if we continue to stay below this $70 level, then the downside's coming a lot faster. Just like with gold, I'm in the camp for a short-term bounce now. Silver, again, has dropped massively. I mean, if we do a percentage here, we can see just since May 10th, to the lows today was a 32% drop. GDX is another one of my favorites here. I actually did go long GDX today because of its 35% straight drop down. And again, I think there's a swing trade here for upside on GDX back into the 94 range. But once that achieves, then I have to start looking for that next leg down.
If the dollar continues to weaken and geopolitical risks are still not certain, gold and silver can continue to gain. On the other hand, an increase in yields could put a new brake on the upside. Long-term forecasts beyond 2030 are less reliable, but several scenarios suggest a gradual increase in gold prices. According to long-term estimates, gold may surge to $21,247 by 2037. As markets continue to navigate uncertainty and shifting monetary policies, will investors be able to withstand short-term volatility to capitalize on the long-term potential of precious metals? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.